Let's move. Let's talk other areas too. We've got earnings coming in Alcoa, and that means it's what month is it? April.
Mm-hmm. The cruelest.
Well, it's March was that's the end of the first quarter. So it's going to be unbelievable. A lot of them.
You don't have any vacation soon, do you?
Yeah, I do.
Oh, you do?
Oh, yeah.
He always leaves for
April 20. No, I don't. You know what it is? Spring break for kids. It's dependent on when they're off. That is all it is. Let's talk about Alcoa. Let's talk about an earnings preview with Dan Morgan, portfolio manager at Sonova Securities. Dan, I don't know if you have coworkers like that. Well, never mind. But what are your expectations for earnings growth for the first quarter? Where are we going to be?
Well, we're looking for earnings growth in the first quarter to kind of break the trend that we've had over the last 14 quarters. We know we've had 14 quarters of double-digit earnings growth, the longest streak since 1952. The fourth quarter was up over 10%. And I think what we're missing here, Joe, is a catalyst. In the past, we've always had a group within the S&P 500 that's done really well, like energy, like financials during the housing boom. So going into this first quarter, we're only looking for maybe 5 to 6% growth, which is a big slowdown from what we saw in the fourth quarter, which is over 10%. So looking for things to kind of slow down a little bit from the great growth that we've had over the last, over 3 years.
Yeah, and what do you attribute that to, really? Just no energy comps, no good energy comps?
Well, energy, financials, we had the basic materials.
What's wrong
all
with
the commodities
financials?
ran.
Subprime, you mean? Not Goldman Sachs, that's for sure.
Right. The investment groups have done well, no doubt about that, but we've definitely seen a slowdown in the housing market, as you just talked about, and that's impacted a lot of the big banks. If you look at a lot of the money that's been made in companies like Washington Mutual and Wells Fargo and so forth, a lot of it's tied to the strength in the housing market in California and all the volumes and so forth. So we don't have that catalyst that we've had in the past.
But are we going to ham and egg it a little bit here? I mean, technology is going to be pretty good, right?
Right.
And what about
if you go through
industrials?
Exactly. If you go through the groups, consumer staples, which do well regardless of economic growth, looking for about 10% growth. If you look at the technology sector in the beginning of the year, the consensus was like 23% growth in earnings for the year. That's kind of pulled back quite a bit since we had some mid-quarter updates and weren't exactly what everybody was hoping for. A lot of that's been pushed off in the second half of the year, only really looking for about 13% growth. And industrials looking for slightly above the S&P 500 growth rate, which I said was about 5 to 6%.
You just heard, I don't know if you were listening, but we just had a pretty gloomy report on the housing industry, not just from D.R. Horton, but from Steve Leisman. Do you expect us in the second or third quarter to be talking about all kinds of disparate earnings reports from all different sectors and saying, looks like all this finally spread to some of the rest of the economy? Are you expecting that?
Well, I hope not. I hope we don't see what we saw back in 2001 and 2002 when the companies had those big write-offs on those corporate loans. Of course, this would now move over into the housing area and the subprime area. I think the thing we've got to focus on going this quarter is any of this bad news that we're talking about this morning, is that starting to trickle down into the Citigroups and the JP Morgans and the Wells Fargos? Are we seeing delinquency rates going up? Are we seeing loan losses, provisions being increased by management, anticipation that things are going to start to deteriorate in that sector? I think that's what the market's really going to be focusing on to see if there's any credence to this whole subprime concern. Is it going to deteriorate earnings going forward?
It's the biggest boom, it seems like, that we've ever had. Shouldn't we be expecting that the bust could be worse than your average bust?
I hope not. I hope it's not like the technology bust back in 2000, 2001.
You keep bringing up all these terrible things that you hope it's not like. It makes me think.
I hope it's not like.
Yeah, because it happened before.
It happened before, that's true. I mean, I'm hoping that, the fact that unemployment is so low, at 4.5%, wage growth continues to be strong. That's what the Fed is focusing on. Hopefully that allows us to overcome this and get through this bump and move forward. I think if unemployment goes up, obviously that would be absolutely detrimental to that recipe for recovery.
All right, Dan, thanks.
Okay, thanks, Joe.
He's like in the investment business. He's not in the media business where we're hoping for all those things, right? House is not burning, little lady. Blood in the streets. We need it. We'll have leads every day. More foreclosures, a recession, stock market's plunging. You must watch.
The media doesn't go to the airport and watch planes land safely.
Oh, yeah. No, it doesn't, right? I know. I'm not going to...
Cynics.
Exactly.
I work with cynics. You talk about your terrible colleagues.
Oh, I know I'm the worst, but I'm dragging you down.
There is a lot going on this too.